Hey everyone, and welcome to the Noob Selling Options channel. So today, we're going to talk about a real titan, Apple. I mean, this company is an absolute masterclass in how to run a business. But, and this is a big but, just because it's an incredible company, does that automatically make it a great investment right now? Let's dive in and find out. All right, let's just get right to it. Apple is, without a doubt, a phenomenal company. But I am not buying it. And you're probably wondering why. Well, it's because there's a huge difference between a great company and a great investment. And for Apple, at this very moment, those two things just don't line up. Now, before we get into the nitty-gritty of the numbers, we have to give credit where it's due. Apple has built an absolute fortress around its business. And to really understand why the stock is so expensive, you first have to appreciate why everybody is just clamoring to own a piece of it. So what makes Apple so powerful? Well, it really boils down to three core pillars. First, you've got these incredibly high switching costs. Then there's the services division, which is just a pure cash cow. And finally, they are masters of some very clever financial engineering that keeps their shareholders really happy. Let's talk about that first pillar, because it's a big one. Once you're inside the Apple ecosystem, with your iCloud, your iMessage, all your purchased apps, leaving is a massive pain. Seriously. It's not just about getting a new phone, it feels like you're uprooting your entire digital life. And what does that do? It creates this unbelievably sticky customer base. And because that customer base is so locked in, Apple can just monetize it over and over again through its services. We're talking the App Store, Apple Music, iCloud, all of it. And get this, a 76% gross margin. I mean, that is just staggering. It provides this incredibly consistent, high-profit revenue stream that, you guessed it, investors absolutely drool over. Okay. So, we've established Apple is an A-plus company. No arguments there. The problem? Well, the market knows this too, and it has priced the stock for absolute flawless perfection. And that, my friends, is where the risk comes in. So let's look at the actual data. The stock is sitting at an all-time high. Its forward PE ratio, which is basically what we're paying for future earnings, is over 32. That is rich for a company of this size. And then you have the PEGY ratio, which kind of measures price against growth. It's at 3.0. Now, usually, a PEG of 1 is considered fair value. So 3.0, that tells you the price has sprinted way ahead of the company's actual growth. When you pay a valuation this high, you're not really just buying a company anymore. You're making a bet on a perfect future. You're basically assuming they're going to have a massive iPhone supercycle, that their AI rollout's going to be flawless, and that there won't be any economic hiccups along the way. If, and it's a big if any one of those things doesn't go perfectly, there is zero margin of safety to protect that stock price. And this brings us to the single biggest danger here. It's called multiple compression. Look, in simple terms, this is when the market just decides to pay less for the same amount of earnings. So even if Apple's business keeps doing great, the stock can fall hard. If investors suddenly decide, you know what, Apple is worth 25 times earnings, not 32, then that stock price is coming down no matter how many iPhones they sell. That's the risk you take when you buy at the peak. So it's too expensive now, but we still want to own this world-class company, right? Of course we do. The question becomes, what's a fair price to pay? So let's use the data to figure out a disciplined, smart entry point. Our goal here is to find a price that gives us a real margin of safety. So instead of that risky PEG of 3.0, we're going to target something much more reasonable. Let's say 2.0. And to get there, the math tells us we need the forward PE ratio to come down from that lofty 32 to a more grounded 26. And when you run those numbers, when you plug in that PE of 26, what price do you get? Well, it spits out a target price right around $204. That's the price where the valuation starts to make sense again, where the risk and the reward are finally back in balance. And hey, don't just take my word for it. Let's look at what a really respected third-party source, Morningstar, has to say. Their analysis pretty much confirms that, yeah, the stock is fully valued right now. Take a look at this. Morningstar's fair value estimate is $260, which is exactly where the stock is trading today. They give it a 3-star rating, which basically means it's fairly valued. The key takeaway here, there's no discount. There's no margin of safety. You're paying exactly what it's worth today, and that is not how you find great investment returns. Okay, so we've got a great company, a high price, and a target of around $204. What's next? We don't just walk away. No, we create a disciplined game plan. We wait, and we let the market give us our price. So here's the playbook. It's a simple 3-step action plan. Step 1, we wait. We do nothing until the price corrects and heads down toward that $220 range. Step 2, as the price falls, Fear in the market is going to rise, and that will cause implied volatility to spike. Step 3, that's when we strike. We'll use a strategy called selling cash-secured puts with a strike price under $200, and that's how we create a powerful safety net.
Now, for anyone who's new to this, a cash-secured put is a fantastic strategy. In simple terms, you are getting paid cash today, that's called a premium, for simply agreeing to buy a stock you already love, but at a lower price in the future. It's kind of like setting a limit order to buy, but you actually get paid while you wait.
And this is the beauty of the whole strategy. I mean, we get the best of both worlds. We get paid a nice premium for our patience, and if the stock actually does fall to our target price, well, then we get to buy a world-class company at a genuine discount, far, far below today's sky-high levels.
Ultimately, this all comes back to the central theme of this whole analysis. You have to have the discipline to remember this one simple rule. Apple is a fantastic company, but at $260 a share, it is not a fantastic investment. By being patient, we can make them one and the same.
So I'll just leave you with this final thought. In a market that is constantly rewarding speed and chasing the next hot trend, is simple patience the most powerful yet most underrated tool that we have as investors? It's definitely something to think about.
Thanks everyone for sticking with me. If you think this explainer was useful at all, please do me a favor and give it a strong like. It really does help the channel a ton. Thank you.